trader and algorithmic trader specifically. Now I'm working with one of the Ahmedabad-based fund managers to set up the fund management practice. And if we talk about the order flow on which we will be taking the session today, this is the setup that I use on a daily basis when I have to trade options. I will be giving a glimpse into what the order flow is, what are various tools that are there available in the order flow, and how do we use it for the trading setups using order flow. The order flow data is not directly available through NSE. So I'm using a third-party application called Go Charting to view the order flow data and take the trading decisions. So let me share my screen and then we'll get started. Let me know once you can see the screen, Nilesh.
Yes, Neil, please proceed.
Okay. So yeah, so what we will be discussing today is how do we understand the market intention through real-time price and volume data through order flow. Specifically, we will be focusing on how do we leverage order flow data in option trading. This is the standard disclaimer that we are not SEBI registered advisors, and this is purely an educational session. It shouldn't be taken as investment advice. So in today's session, we will be discussing the core concepts of the order flow. We will learn how buyers and sellers move the price as well as the whole market. We will look at how to interpret the liquidity and delta. Delta is one of the core concepts in order flow. We will discuss it later. We will use order flow for better option trade execution. And finally, we will look at how to improve the risk management and consistency in trading. So these are the key objectives for the session today. Now, if we talk about what is order flow. So order flow is basically a real-time buying and selling activity that is happening in the market. So many of you may be aware of DOM, which is called depth of market, or in old terms, it's called tape, where you can see the number of buyers and sellers in terms of how many bids are there, how many asks are there. So that is something on the limit order. Those are the limit orders that are there in the market. So if I, let me share my other screen as well. Second. Let me know if you can see the screen.
Yes, Neil, the screen is visible.
Okay. So here we are looking at the market depth. Here on the left side, we are looking at the bid, and on the right side, we are looking at the ask. So this is the example of how the market depth looks like, where the number of buyers are there on the left and number of sellers are on the right side. I'll move back again to the presentation. So we will be looking at how the market participants are being tracked using the order flow. We will identify the institutional footprint using the order flow. And then we will look at how the price moves, not just where the price moves. We will understand why the price moves. So as I mentioned, these are the core concepts: bid versus ask. That's something that I just showed. Then we will understand what is market orders and what is limit orders. So what we saw in earlier screen was the number of limit orders that are there in the market for that particular instrument or let's say strike. So those are the limit orders that are placed by various entities, and those are executed against the market orders. So when you execute a trade, it gets executed against a limit order that is there in the market. Then we will be looking at how liquidity and absorption takes place. For example, when one side absorbs the move of the other side, the buyers dominate as compared to seller. That is called absorptions of the sellers. And when sellers move the market on the downside, that is absorption of the buyers. So we will look at that as well. In order flow, there is a concept called imbalance, which is basically the difference between buyers and sellers. And when it is significant to be ignored, that is called imbalance. As I mentioned, we will also discuss about delta and what is cumulative delta. And finally, we will look at how the market profile looks like in the order flow. So what is order flow? So order flow, as I mentioned earlier, is nothing but a presentation of how the buyers and sellers are executing the orders in the market. So order flow looks like this. Order flow data looks like this in a chart, where the buyers are shown on the right side and the sellers are shown on the left side. I will show shortly a chart where we can look this data in the chart directly, so you will get a better understanding of what I'm talking about. When there is a significant imbalance between number of buyers and sellers, that is called imbalance. When there is maximum participation of buyers and sellers at a particular price, that point is called point of control. Sorry. And overall, in a particular candle, the total number of buyers and total number of sellers, a difference between both of them is called delta. So I will move again to the chart and we will look at how these data looks like in an order flow. Do you see the screen? The order flow screen?
Yes, Snehal.
Okay. So this is what the order flow screen looks like. Here we are looking at a 3-minute candle where we see number of buyers on the right side and number of sellers on the left side. And these are the market orders. So when this price executes against the depth of market that we saw where bid and ask was showing. So when this candle is formed, it basically executes these many orders against the limit orders that are there already in the market. And then the candle moves. So if we look at this particular candle, this part is shown as imbalance, because the number of buyers here are significantly more compared to the number of sellers. So this is an imbalance in the chart. I will show what a point of control looks like as well. So this is the point of control where the maximum number of trades took place. Number of buyers and sellers, when those are the highest, that is called the point of control. So here if we look at the number of buyers and number of sellers, there are 17,000 number of sellers and around 6,000 buyers that are there. So this is how the order flow data looks like. We will look into detail how do we leverage this data. As I mentioned earlier, there is a thing called delta, which is nothing but a difference between number of buyers and number of sellers in a specific candle. So if we total or sum the number of buyers for this particular candle and sum the number of sellers in this particular candle, and consider the difference between both of them, then we get a value which is called delta, which is nothing but we understand who is dominating in that particular candle. So if this candle is showing as green and the value that is shown in the delta at the bottom is in green, that means that the buyers are dominating in this particular candle. There are number of more buyers than the sellers. 8,000 more buyers are there in this particular candle than number of sellers that are there. So that is called delta. There is a thing called cumulative delta at the bottom. In the third block, you see the cumulative delta. The cumulative delta is nothing but basically for that particular session. So if we are talking about this these order flow data, this is of yesterday, which is 20th of May. So for 20th of May, there were 43,000 number of sellers more in the market as compared to number of buyers throughout the day. And whereas the delta is just for this particular.
Snehal sir, just a very relevant question from Dheeraj. That is it the number of buyers or sellers, or is it the quantity of buy and sell orders?
So that is quantity itself. The number of orders.
Okay.
It is the number of its quantity, not the rate. It's a quantity. When we look at the, let me show again the depth of market. So here we see bid and ask, which is nothing but a price. So at 56 rupees, there are 65. So there is one lot of order someone has placed an order for. So there are 3 lots pending here. So these are all the limit orders that are there. And these are the quantities.
Right. Understood. Yes,
So
please
similarly, what we see in the order flow is also a quantity. Is it okay?
Yes, Snehal, it's clear.
Okay. So I'll move back again to the presentation now.
Yes, please go ahead.
So yeah, this is something that we saw how the buyers when we talk about buyer, I'm talking about the orders or number of quantities that are there. I'm not telling that how many buyers are there. I'm talking about the quantity of orders. Okay. So going forward, I'll refer to it as buyers and sellers, but essentially I'm talking about the number of orders of buyers and number of orders for sellers. Okay, we'll move to the next one. We saw how the bid and ask is there in the depth of market or DOM. And those are the limit orders. These are the passive orders. So these are when we look at the depth of market, what we are looking essentially is a order book. And those, all of them are the limit orders. Their limit order quantities we see on the bid side. We see the buy quantity. Someone wants to buy at that particular price, those many quantities. On the ask side, what we see is the number of sellers that are there. And how price moves is because of the market orders. Unless there are market orders that consumes the limit orders, the price doesn't move. So when someone places aggressive orders from the in the market, that executes the limit order and then moves the price. When the price, there is a difference between bid and ask. That is called spread. So when price is moving across the spread, when someone is buying aggressively, that's how the price moves. Liquidity and absorption. So here in this particular, this is an example of a candle of order flow. Here we see a large passive order of limit buyers that get executed against the market buyers, and there is a sellers on the left side. This is called resting liquidity. So unless market order executes this order and price moves, this liquidity is not swept. When we say liquidity is swept, that essentially means that from the order book, the limit orders that are there are consumed by the market orders. That is called liquidity swap, and that's how the price moves. As I mentioned earlier, the imbalance is nothing but a difference between number of buyers and sellers at different prices. So let's say if we talk about this particular example, the 1937.50 and 1937.75. So these are the various prices, and at each price there are number of buyers and sellers. So these, when market order comes, it executes against these limit orders, and that's how the price keeps moving. When there is a heavy imbalance between number of buyers and sellers, that depicts that the aggressiveness of the buyers or sellers. In this particular case, we see that number of sellers are significantly more here. That means the sellers are dominating in this particular candle. They want to absorb all the orders or liquidity that is there from the buyers. So when buyers wants to buy the order, there are sellers available who wants to sell at those prices. Delta and cumulative delta, as I mentioned. So let's say this is an example of a divergence. Let's say the price is moving up, but the delta or cumulative delta is moving down. That means the move that is happening is hollow. It can go down. The move can go down when there is a gap between the delta and the price. So this is an example of delta divergence. We will look at it in a later part as well in the chart. What is market profile? So market profile is a kind of profile that where we understand where the maximum participations of buyers and sellers took place. So this is how the market profile looks like. I will show it in the actual chart, so you will get a better understanding of how the market profile looks like. One second, I'm just switching the screen. Okay, so I will move to the 30 minutes candle. Okay, and I will disable the imbalance chart and I will enable the market profile. So this is how the market profile looks like. So what it essentially means is how much time the price has taken at that particular point in time. This is also called time price opportunity. And these are depicted in terms of the alphabets A, B, C, D. Wherever the maximum number of time is spent, that is called point of control in a order flow. And there are areas where there is a limited activity outside the point of control. Those becomes the value area high and value area low. So this is called a value area. So when we say value area, this term you must have come across many times. Value area is an area where there is a kind of kind of syncing between buyers and sellers. They are happy within these prices. The buyers are getting their buy orders, sellers are getting their sell orders. But when they moved beyond the value area, that's when the move starts. Within this range, you will not see significant action. But when you move beyond this range, there will be a move that will be accelerated. So this is how we mark levels in the order flow as well. So what we do is here, we mark the value area high, which acts as a resistance in the market. And then we mark the value area low, which acts as a support in the market. And the point of control is the area where the maximum activity of order execution takes place. So this is how we mark the support and resistance using the order flow. If we now move to the imbalance chart and move to a lower time frame, we will actually look at how the price has moved around this area. So what I'll do is I'll turn off the market profile for now. Now you look at how the price has moved around this area. When the price came near the resistance, that's where the number of sellers aggravated. They became aggressive. You can see on the left side there are more number of sellers here. Here also you can see a significantly number of more sellers, and that's how they moved the price down. This is the candle where the maximum activity took place. It tried to consolidate the price here around these area, and then when the aggressive move from the seller came, that's when the price moved down. So this is how we mark the resistance and support using order flow. Probably we will have a subsequent session in which we will discuss these things in detail, but this is just an overview. I will move again to the presentation and we will discuss further. Okay, so this is what we saw essentially. This is the value area, and this is the point of control where the maximum buyers and sellers were there. And out of the value area is the area where the participations of buyers and sellers is low. What happens essentially in the market is the price moves from one market profile to another, the next one. So it basically, if it goes beyond this value area, it will try to find what is the next value area, and it will try to sustain price there. So that's how the price moves, and we can look at it in the live market. That once the price moves beyond this value area, it tries to find the next value area. So as I mentioned, aggressive buyer lift the ask. So in depth of market on the ask side, the limit buy orders are there, so those are consumed by the sellers, the aggressive sellers, and on the buy side, bid side, those are aggressive buyers lift the ask. So the selling is lifted by the market buyers, and buying is lifted by the market sellers. Price moves when the liquidity gets consumed. So let's say in a specific at a specific price, there are more number of limit orders that are there. For example, round number figures. If we talk about 23,500, then that will have a maximum limit orders placed around that range. And when a price moves towards that area, and at that area, we will look at how many number of buyers or sellers are there. Let's say if the number of sellers around 23,500 are more, then the price will move down from there. If there are number of more buyers there, then the price will move up. So that's how the liquidity gets consumed. and a large absorption can stop trends temporarily. So, for example, there are more number of sellers that are there in the market around that price. Then what will happen is market will not move beyond 23,500. It will reject from that level and then search for the next liquidity at the bottom. So this is what we discussed, how the aggressive buyers and aggressive sellers executes the orders. They basically consume the limit order and then move the price, whether it's on the upside or downside. It depends on how many number of buyers and how many number of sellers that are there. How the price moves. So let's say there are buy orders, buy market orders that are there, and at each price levels that are there are limit orders. So when those limit orders gets consumed, the price moves up. Absorption stalls the trend. So as I mentioned, let's say 23,500 is the maximum number of sellers, then the price will drop from that level and try to find where is the next liquidity, because the sellers are looking for buy orders. So if there are more buy orders at the 23,480, it will go at that price, consume all the orders, and then the price will again try to move up.
Snehal, can we go back to the Go charting, and can you show us where exactly on the charts you are able to see the trend reversal? Because a lot of people wait for key levels, rejection or support for entering a particular trade, right? So I think that would be super helpful for the rest of the audience.
Sure, let me do that. So I will give some example where the price has moved from a particular level. Especially the round figure number. We'll try to look at that. So this is 23,550, right? So this is a level where we see that the buyers tried to buy again. So basically, let me find the example, proper example, where I can show how the buyers dominated. I will go on a lower time frame and try to find a setup. So let's start to walk through the how does a day looks like. So you can see the order flow chart, right?
Yes, Neil.
Okay. So the day started here. Here we saw that the number of sellers here are more and number of buyers are less as compared to the sellers. So there were 9,000 less buyers than the sellers. But the price moved up. That shows that the buyers are dominating in the market right now. What happened thereafter? The delta kept increasing. That means the buyers are still dominating the market. Then you move, the price moved up. Now here we see significant number of selling that is there. There are 20,000 sellers, 20,000 buyers, but overall, if you look at the difference between number of buyers and sellers, that is 21,000. That means here the sellers are dominating in this particular candle. So there were market orders that took the price down. So the price came down. Again, the price tried to move against that level. Again, it tried to come down. If you look at this particular candle, here the buyers are dominating. When the price again came at this particular level and the buyers are dominating, that means that the number of limit orders that were there here in this particular candle have been exhausted. So that's when the price will move up. So it came down, it took some liquidity and then again moved up. Here we see the number of buyers that are there are more compared to the sellers, but then the price did not sustain. That means the market orders took the limit orders at this particular level and moved down. So this is where we will mark this level. When we see this significant number, we see a heavy volume of buyers, but then price is still going down. So we will mark this zone, and we will see if the price again try to move down from this level, then we will take a trade from this level, that the market will go down from this level. So let's say this is the level which we marked. Now the price has come again. We will see whether the price is sustaining here. Does it move up or does it get rejected? In this candle, the price rejected again. So this is when we can take a trade there on the bearish side, and then ride the move until this level. So which is around 50-point move. If we talk about the numbers, it's around 790. This is a round figure as well. So as I mentioned, this is a psychological number, 23,800. That is where the rejection chances are high. If the price is moving up from the bottom, the chances of rejection at the psychological level is high. So that's how the price got rejected twice here. Then we continue looking at this level, and we see that price has come here. Now we look at the number of buyers and sellers here. We see that the delta, cumulative delta, is constantly increasing. That means there is a buying activity that is happening here, and the sellers are being absorbed. And then that's when we look at the data, we will understand that here there were 18,000 more sellers, then those get consumed. In the next candle, we see there are more buyers than sellers. Again, number of sellers that are there, but then the price is also moving up with non-significant number of difference. The price keeps moving up. That means the orders are getting executed of the sellers. So sellers are being absorbed at this level, and the price is moving up. So and then again, when it broke this particular level with significant delta, that proves that the price wanted to move up. It moved up until this level, and again the sellers dominated from this particular level, and the price came down. So this was a kind of a ranging day. Yesterday was a ranging day where the price did not move significantly in any direction. It basically ranged around this area. This was the only significant move. Now let's identify what happened and how the move started for this particular candle. So here there were a number of significant buyers that were there. The price moved up, but then did not sustain. The price came down. The number of sellers started increasing one by one, and the price started to come down. So this is what we will mark as a rejection area. If we look at the number of buyers and sellers, we see significant number of buyers that are sellers that are there in the market as compared to buyers, and the price is being rejected. So we will mark this as resistance, and we can take a trade from this particular level. If the price doesn't go beyond this level, then we can take a bearish trade, and the trade played nicely here. There was a heavy selling in this particular candle. Again, the price came up, did not sustain, and moved down, and the mood continued throughout the day until here. Now here what we see is there are number of, so these are the limit orders that we see that got executed, and the price moved up from this level. There were significant sellers, but the price still moved up. That means we can mark this area as support area, and from this level we can take a bullish trade, and the price moved up from this level. And it moved significantly. That means the buyer dominated at the end. So there is a chance that when the market opens on Monday, the buyers will still dominate. That's a chance. But it depends on the news and various conditions that are there in the market. So this is how we basically identify the levels where the rejection is happening in the price, and we compare it against the delta. Delta and cumulative delta. Cumulative delta is, this is how the cumulative delta chart looks like. It keeps moving up and down. If the chart is moving down, then there is a heavy selling. We can understand that the market wants to go down. I'll move back to the presentation again. Yeah, so this is how the absorption that we discussed, that absorption stalls the trend. So the price was trending around 23,800, but it did not sustain. So it came down. This is something that we have already seen. Market profile, depth of market also we have seen. VWAP and liquidity zone. So I will again move to the chart. I will enable the VWAP here. So we can see that the price is, when the price is trading above VWAP, VWAP acts as a kind of support or resistance in most of the cases. So if the price is sustaining above the VWAP value, that means the buyers are dominating in the market. If the price is sustaining above the VWAP, below the VWAP, that means the trend is weakening. So here the price moved beyond the VWAP because around VWAP there is a heavy liquidity as well. The limit orders that are there around VWAP, and the price moved down. So the price sustained below the VWAP when it continued the down move. So that is how we use it in the VWAP. Also, in VWAP there are 3 standard deviations that we can mark. This is standard deviation 1. We can mark 2 and 3 level as well. That and we see that how prices move around these levels. I'll remove this box so we can see it clearly. So this is the VWAP band, the middle band, and this is the first standard deviation. This is the second standard deviation. This is third standard deviation. So the price moved here in the second deviation, then again tried to came down, sustained below this level, and throughout it tried to take the liquidity here, tried to move up but did not sustain, came down. So these VWAP bands also acts as a liquidity zones, because there are more pending limit orders around these levels. I'll move to the presentation again. So this is what it was talking about. If the price sustains, that means the buyers are dominating above the VWAP. And if sustains below the VWAP, that means the sellers are dominating. These are the key trading setups. We will look at with examples of each one of them. Breakout with aggressive buying, absorption and support and resist. Absorption, support and resistance is something that we have seen recently in the chart. We will look at the breakout with aggressive buying. We will also look at the trap buyers and trap sellers. Delta divergence, we will try to find an example if we can find. And then finally, liquidity sweep and reversal. So let's look at the chart and then look at those examples one by one. So we will try to find where the breakout happened. I will move to the higher time frame so we can see it clearly. Okay, so 1 second, I'm just trying to find an example. Right, I think we have one here, which is 21st of April. I'll move to the lower time frame now. Okay, 21st of April. Yeah, here. So here we can see a significant move and we see a breakout. And how do we identify a breakout? So the day started with number of buyers more. We can see at the bottom the delta is good. That means the number of buyers are more in the market. Then there was a slight consolidation. The price there were a number of sellers more here, but the overall cumulative delta, which is number of buyers throughout this particular session or particular day, was still more when we saw here. The price sustained around this level. So if we look at this area, we see the selling and buying here significantly more at this particular zone. If we see number of buyers and sellers in this particular zone, in each candle, there is a significant difference between number of buyers and sellers. And then finally, this particular candle, if we look at the volume of this candle, it's very high. If you look at the delta and cumulative delta is basically sum of the delta throughout the day. But if you look at the delta, it is significantly high compared to all other candles that we have seen so far, except the first and second candle. So first candle had 61,000 more buyers, second candle had 96,000, and this candle had 83,000 more buyers. And then with that, the price moved. That means this is a breakout trade. When the price comes back or gives a pullback, that is when we can take a bullish trade in this case. So let's say price did not come back again at this particular zone, but then it pulled back a little bit. So here also we can take a trade. We can look at the delta. If we see a positive delta, for example, this candle, there was slight pullback, and then again the price tried to sustain. And this is here we can see significant delta again more, which was positive. So we can see this is a breakout trade. So here also, if we have taken a trade with a stop loss below, for example, this low of this candle, then we can see the price has moved significantly more on that day. So this is the kind of breakout trade where you see that there was a heavy activity, there was heavy buying or the heavy selling, and the price moved up or down depending on whether the buyers were more or the sellers were more, and the price moved. That is a breakout trade. So this is how we identify a breakout trade with a significant activity in the order flow on the one side. So that is a breakout trade example. The next example we have to see is absorption at support and resistance. That is we have already seen. We will look at trapped buyers and trapped sellers now. So I will try to find an example for that. Probably in this candle itself, we will see that example. Let me see. Yeah. So here we see that the significant number of sellers here, right? You can see 17,000 sellers are there, 20,000 sellers are there, 11,000, 7,000, 4,000, 8,000. So this zone, the number of sellers are heavy in this particular zone. But then the price moved up. So when the price moved up, now these are the trapped sellers. So they can't they can't exit unless they have to book a loss. So that when the price moved, now these guys are trapped. So this is called example of trapped buyers, trapped sellers. Similarly, if these buyers are trapped at a higher price, we will see example of that as well. Probably not in this particular day, but some other day. Just trying to find an example. I think here we will have one. Yeah. So if you look at this level, right from this price, the price is more. So this is middle of the day, like 115, 120 around that time. What it did was it gave up kind of breakout trade, but with a heavy volume. But the price did not move significantly. If you look at the delta, it's heavy. 35,000 more buyers than sellers, 25,000 more buyers than sellers, and 37,000 more buyers than sellers. But the price did not move up with this significant delta. If the buyers are more than sellers, then the price should also move up, but it did not move. And if you look at the number of sellers in this area, number of buyers in this area, that is significant. And the price, when the price went down with a heavy selling in this particular candle, now these buyers are trapped. They can't exit their trade. So when the price comes again in this zone, you can take a bearish trade, because these buyers are never going to get their exits. So they are still trapped. The price kept moving down, and throughout the day it's kind of consolidated and ended at the peak bottom. So this was the example of trapped sellers. Trapped buyers. Then delta divergence. Okay, I will try to find example of delta divergence. I'm just trying to see. Probably we will cover it in the next session. Yeah, and liquidity sweep and reversal is something that we have already seen. When there is a liquidity sweep and then the price came down, for example, in this level, there was a liquidity around 24,100. The price came here and then started moving down from here. So this is a kind of liquidity sweep. So these are the key trading setups that we can use in trading using order flow. I will move again to the presentation. So these are the various setups that I mentioned. We couldn't find example of delta divergence right now. So we will probably cover it in the next session, and rest of them we have covered. Breakout with aggression. So when the breakout happens, we saw a breakout example as well. it has to happen with aggression. So there should be a number of more buyers and sellers. Then the chances of that breakout sustaining are high. Otherwise, it will be low. Absorption and support and resistance, that is also something we have seen. Trap traders example, we saw that at the top, the buyers are trapped and the price kept moving, so they couldn't exit. Delta divergence, we couldn't find an example. Liquidity sweep is also something that we have seen. How to manage the risk when we are doing options trading? So basically, one thing that we have to keep in mind is the position sizing. So based on the risk that we want to take, we have to identify the ideal lot size or number of lots that we want to trade, and then manage that position. Avoid the over trading. The main thing that happens with traders who specifically deals in options is over trading. So let's say you incurred a loss early in the morning, then what you'll try to do is you'll try to recover that loss and take a second trade. Now, let's say if that second trade also incur the loss, then your psychology will be impacted and you'll continue making loss throughout the day. So this is something which is pretty common between traders. So if you see that there is no opportunity, then don't force the opportunity. Don't try to find the setups if you can't find one. So people try to do multiple trades, and then at the end of the day, they'll be in heavy loss. So that is something that has to be avoided. Use predefined stop loss levels. So as I mentioned in the chart, we have to identify the support and resistance using the market profile and use them as the stop loss levels as well. So when we take a trade, we should see if the price is breaking above the value area high or below the value area low, then we have to mark them as the stop loss level. So let's say if you are taking a bearish trade, the value area low will become our stop loss, some points above the value area low. And if we are taking a bullish trade, then when above the value area high, then the value area high minus few points will become our stop loss. And we should focus on the execution quality rather than number of trades to be taken in a day. Unless we find a entry based on our setup, we shouldn't enter the trade. And there are certain sessions. So there have been few sessions in recent weeks where the price did not move beyond a specific range, even beyond the 15-minute high and low. So on such days, especially option buyers lose a lot of capital. So we have to identify such days when the price is not being moving beyond a range, and then avoid trading on those days. So how do we basically use order flow? Identify key levels. We have to identify what are the support levels, resistance level, and point of control using the market profile, and then take a trade when the price try to move beyond the value area. We have to identify how the liquidity is building up and who is dominating in the market, whether those are buyers or sellers. We have to wait for confirmation. So let's say there was a heavy selling at a particular price, and then you take a bearish trade, but then the price come back again at that level. Unless there is a retest and confirmation, you shouldn't enter the trade. You can enter the trade, but then if price moved against you, you'll incur a loss. So it's better to wait for confluence and confirmation rather than execute multiple trades in the fear of missing out mode. And then you have to execute with discipline. Common mistakes that traders do is using order flow is trading every imbalance. We don't have to trade every imbalance. We have to identify the key levels where the imbalance is happening and someone is dominating. So we have to trade only those areas where we see the confirmation that one side is becoming aggressive. We shouldn't also take trade against the trend. So, for example, if a higher time frame trend is bullish, then we should try to see that we don't take bearish trades just because we think that the market is going down. It could be a trap. So we can avoid that trap if we look at the higher time frame context. Confusing volume with direction. So this is also what happens. So if we see significant volume, that we see that there are a number of buyers more in a particular candle, and we enter. But that shouldn't happen. We should also identify levels, and if that is in confluence of other factors, then only we should take a directional entry. When the trade is exhausted, at that time we shouldn't take an entry. So late entries also incur a loss. We shouldn't also over leverage our position. We should know our position sizing and then stick to that. So yeah, so we saw in the session today, it was a kind of, so there are many things in the order flow that is very new, and probably in this one session we wouldn't be able to grasp those concepts. But this was just a try at explaining what the order flow looks like, what the market profile looks like, how to draw support and resistance, how to identify who is aggressive in the market on a particular day. So yeah, so I tried my best to give an understanding of those concepts. But we can have a follow-up session with the detail of each of these topics in detail. Executions matter more than prediction. So you just don't guess the direction whether the market is going to be bullish or bearish. Rather than that, we should focus on what market is showing you in terms of the data when you're looking at the order flow. Discipline and patience are critical, and consistency only comes from structured observation. So if you start trading using order flow, you should keep looking at, you should start observing first rather than taking trades based on order flow. You observe it for the week, for the month, then take a paper trade, observe whether your trades are going in the right direction, whether you are understanding the concepts, and then you start executing the real trades. So that's about it from my side, Nilesh.
Thank you, Snehal. I think this was very informative, and I know order flow is a very heavy concept, in terms of its own depth and the breadth involved. So a lot of questions that came in. I would not, try to cover everything, but a couple of key questions which were there. One was around how do we identify some of the situations where there is a manipulation going on in terms of, some bulk orders being placed by a large institutional player. Is there any view that you can, provide to the audiences on that?
Yeah, so as I mentioned, the example is trapped buyers and trapped sellers. So when someone gets trapped, that means the institutional are going against that trapped buyers or sellers. So how do I explain it? Let me show an example in a chart. So we won't be able to exactly identify the institutional activity, but then we can identify that institutional actors are looking at specific direction. So So we see here there was significant number of buyers. One second. No, this is not the example. So basically, when there are heavy orders in the market and the price goes against that, that means the institutional are trying to consume those orders. I can't find an example right now, but the trap buyers and trap sellers example that I showed, that would probably how you identify what institutions are planning to do. They are always trying to go against the retail traders. So if there is a news, that positive news in the market, that the market is going to be bullish. Now, what institution will do is they will already have built their position since long. They don't do day-to-day trading. They do a long-term trading. So they have their positions already built and they know what direction they want to take market in. But then because of news, retailers get a hope that yes, market will be bullish. But then suddenly you see the market start going down. For example, this levels, right? So this is how we know that institutions are going bearish here. They are not bullish anymore. The price gets rejected from particular level time and again.
Got it. I think this helps, but I think one of the most demanded thing in the chat box has been that we need to have one follow-up session where we can see this live in action. So probably we'll try to sync up with you and try to set up something during live market day sometime this week, and we will inform everyone who is attending today's session. One last question, I will there were a lot of questions which got answered either in the chat box or during the flow of the session. One key question which has been repeated is how did you decide onto the platform? So there would be multiple tools which are available currently in the market in terms of using the order flow. So how did you get onto Go Charting, and did you evaluate amongst some of the other tools which were also available?
So TradingView also offers this chart. So if you have a premium subscription, then you can use this on TradingView as well, but that will not be as detailed as Go Charting. But I haven't come across any other tools, especially in India, apart from Go Charting, which offers this service. So let me show TradingView screen, and for few people who have premium subscription.
Yeah, that will be helpful. I suppose a lot of people have TradingView subscriptions. So maybe you can just give us a quick overview there as well.
Yeah. So I'm just loading my screen. So this is how I generally take trades in commodities using order flow. So this is TradingView. Now, if you go to the candle types here, you can see candlestick chart. You can also change it to bar chart or the hollow candles or volume candles, whatever. Here you see three things here: volume footprint, time price opportunity, and session volume profile. So time price opportunity is nothing but a market profile that we saw in the session. So if we want to mark the support and resistance, what we will do is we will go towards the higher time frame, for example, 30 minutes. We will move to the time price opportunity chart. And here we will see where the trades are getting executed. For this particular session, the last 30 minutes of yesterday's session, for example, this is the value area high. This is the point of control. This is the value area low. So this becomes our resistance. This becomes a kind of where the maximum participation will take place. And this becomes our support. If it breaks this value area low, then we have to find what are the next levels. So this is the next level. So then it will try to move towards this level. So this is how the the data looks like, the market profile looks like in TradingView. If we look at volume footprint, this is what the order flow chart looks like in TradingView. And data looks a little bit different from Go charting, but it still shows you the data. You can see on the left side, there is a number of sellers. And if you look at the number of sellers, those are the same. 216, 216. On the right side, there are no buyers. That means this is institutional footprint. This may have been executed through an algorithm. So this is how you can use it in TradingView. You just have to identify this candle type. And this is probably available only in premium. I'm not sure about other versions, but whoever has premium subscription, they can look at volume footprint, time price opportunity, and session volume profile as well. So session volume profile will show you like this, and it will show you where the maximum participation took place. So this is the volume node where the maximum number of buyers and sellers were there. It's always a kind of standard deviation or bell curve type of a chart. Even if you look at whether you look at the market profile or you look at the volume profile, it will be a similar chart with a standard deviation. So this is something how you can explore it in TradingView. And these labels are pretty accurate based on my experience. If you mark these labels accurately, then there is a high chance that you'll get a good trade. So price keeps moving around these levels.
Thanks, Neil. I think this is super clear. Just one clarification question which has come up. People feel that in Go charting, people can connect their broking accounts versus if we compare TradingView where the order stats might not be that real time, makes
Right.
Go charting a better alternative. Is that correct?
Yes. So you can connect your broker. You can have the depth of market from your broker as well. So you can look at the depth of market and order flow both side by side if you use Go charting.
Got it. All right. I think this is super helpful, Snehal. As I mentioned, we will schedule a live market session where we can see you using order flow in action and how do you take decisions in terms of placing trades. So that is something that we will plan and schedule either in this week or next week, most probably.
Sure.
Thanks, Neil. You can now just stop your screen sharing. Although people who have remained so far, first of all, thank you so much for having the patience. We know that this session has been something which is very, very extensive in its own, knowledge base. So we'll try to keep a follow-up session as mentioned, and so that everyone who is more interested on seeing things in action, how do we take real-time decisions on the basis of order flow, we will try to cover it in the next session. Apart from that, one of the surprise announcements that we wanted to announce in this particular session for all the attendees is that I wanted to ask everyone who is so far available in the session to just mention in the chat box, do you trade in any instrument on the basis of patterns? Is pattern something that you actively try to look for, hunt for based on the technical analysis that you do on charts? If you are a pattern hunter or a technical analyst who try to take trade on the basis of certain patterns identified, just type in the chat. I just wanted to understand how many people are there who make their decisions on the basis of patterns on the charts. We have something very interesting around that. All right, Shiva, you see VCP and flag pattern. Okay, flag pattern breakout. All right. Anything else? Anyone?
I also personally trust VCP a lot because VCP structure generally works well because that is the confirmation that the price is consolidating in a tight range and then it is trying to move up. So that means the buying activity from institutions is there.
Right. Okay, this is interesting. So I will just share my screen and show something that we have been internally working on. Let me know, everyone, if my screen is visible to you all.
Yeah, it's visible, Nilesh.
All right. So at Tradl AI, we have built an in-house pattern detection engine. It's still in its early shape. You can see my screen where we have a live feed of patterns being detected at different time frame, 5 minute, 15 minute, 1 hour daily as well. We are currently covering most of the NEC universe of stocks and a library of patterns which either denote a bullish movement in the stock or a bearish movement in the stock. So you can see the direction here and the script name, the name of the pattern, the time frame at which it was detected. We also have an in-house AI layer which uses visual language machines to assess the pattern, because the first level of pattern detection is based on coordinates, which is more like a geometric pattern. Once the pattern is identified, we run a visual machine to verify the confidence score. So you see a confidence score as well. We have different stages in which it also tells you whether the pattern is currently in formation or it's already detected or the breakout has already happened. So this is something that we are going to release very, very soon. So anyone who is interested in a pattern detection engine, a real-time pattern detection engine which surfaces opportunity like this, you can just join our WhatsApp group. We have a separate WhatsApp group. We are currently testing out this feature. This will completely remain free for the early adopters of Tradl AI. So if I just click on something, I can show it to you. How does it look like? So the interface would look like something like this. As I said, it's again in very, very early stages. So don't take it with a pinch of salt that it's 100% not complete though. But yeah, it can give you a sense of what we are doing. So you can see a particular signal. The signal is telling you what particular time frame, which particular script, and what's the pattern identified, and what's the accuracy level here. We are also going to work on the next layer of information to be added over here, which will be in the terms of what are the key levels to watch out post a pattern is detected. For example, if it is a falling wedge, post a breakout happens from this particular identified pattern, what are the key levels that you can identify and potentially try to spot a intraday swing trade or a long-term trade. Totally depends on your call. So the trade call perspective is something that you will have to deduce. This is like a live signal feed based on the patterns that are being detected. So this is something that we have built. I think the team would have just mentioned in the chat box the link for the WhatsApp group. So anyone who is interested in having access to this, feel free to come and join us on the group. We are currently in the testing phase. So anyone who is interested, feel free to join over there. All right. I hope the session was super insightful. And just reiterating, we will have a live session along with Snehal so that we can see order flow in action and how decisions are being taken on top of that. And once this is done, we would also be having order flow tool on the roadmap of Tradl AI, as some of the people asked. So order flow is something that we are deeply obsessed about. We are doing a lot of research. Snehal is assisting us in terms of his own expertise, in terms of how should it be made in a way that it becomes super convenient for active traders, active and serious traders. So that is something that will be coming up very, very soon on our platform. So all the early adopters will get early access to it. And for the pattern detection engine, which I just showed you, please feel free to join us on that group. We'll also make the link available on our WhatsApp group of early believers. So anyone interested can come over there. All right. I think we are already running beyond time. So thanks, Snehal. Thanks again for carving out time on a weekend morning. And thanks everyone who attended this as well. I know taking out time for something as descriptive as this, as informative as this over a weekend morning is really commendable. So thank you so much.